Facebook Live, LinkedIn Live. My audio seems to work. YouTube Live, X Live, Instagram Live. Hello, Anna on Instagram. Thank you for joining us. Are we good to go here? I think we are. Thank you, Ion. Get my comments on. Where are we on time? 101? Perfect. Welcome, everybody, as we wait for people to join. Hey, this is the Winning Momentum podcast. For those of you, where's my camera? I'm going to get my camera here. For those of you that have reached out and asked me about forest fires, is everybody safe? Thank you very much for that. There's the nearest evacuation is about 45 minutes from my town. So we've been safe from that respect. There's a lot of smoke, definitely a lot of smoke. But my area has been safe for sure. Huge fires in British Columbia, into the U.S., Idaho, Oregon, Washington, a little bit of Montana, I believe, are all on fire. So the smoke is intense and it's hard to breathe and you have to stay inside. It's hard to see very far. It's more the breathing that's a problem. But apart from the long-term health damage, we're good. We're good. So I'm going to stay thankful for that. I think we're supposed to have some rain later this week, and hopefully it all works out. This is my pet peeve. As if you're a long-term listener of the show, you know that there's no excuse in either country, in Canada or the US, for this to be happening. If we were to manage our forests, have the right equipment to fight these fires, build in the brakes, this wouldn't be an issue. It's complete negligence. I was going to have a cigar on the deck last night, but I had decided that I'd effectively smoked enough at the dog park. So with the fire, with the smoke from the wildfire. So anyways, all right, let's dive into this as we wait for people to join. 102, it's summer. We're just going to dive in and get things moving. Welcome to the Winning Momentum podcast, where we do a week in review at Sinclair Range, which is what we are doing right now. My name is Scott Sinclair. I'm owner, founder, president of Sinclair Range. And the mission here of this show is to give you some insight into what is going on at Sinclair Range. And I'll tell you what's going on right now is a pop-up on my screen, so I can't see my notes. This shows a real world insight into deals and decisions and the day-to-day rebuild in the journey of Sinclair Range. You can go back and see why it needed to be rebuilt after my illness a while ago. I won't repeat it here, but we try to do this show in 4 segments: the interesting file or deal of the week, lessons learned of the week, struggles of the week, and my musings and observations. We issued a newsletter, a Sinclair Range newsletter last week. I try to do them at the end of the month, but we skip a bunch of months. It's not consistent. I just don't. I don't like to do it as a spam. I probably should, but I don't. I like to do them when I have something to say. But in the writing of that last week, I came up with the new marketing slogan: "Another success from distress." Success from distress. I love that. I love that. That wasn't AI. That was all me. It just came to me. And so you can find the newsletter on our website, sinclairrange.com. And one of those successes from distress was Sirona Pharma. We have talked about that on this show before in the context of Sapphire Global coming in and doing a debtor in possession loan. Well, as a recap, Sirona Pharma was a company, is a cannabis company. When Sinclair Range met them last October-ish, let's say October 2025, they had 2 fundamental problems. One is they had their license to operate with cannabis suspended by Health Canada, which effectively shuts down the company. And the second thing is they had a terrible financial position and balance sheet, and so there was no funds to deal with this problem. Working with counsel, Sinclair Range, back then at the time, it wasn't me personally on the file, but Sinclair Range got the company into CCAA, Companies Creditors Arrangement Act, in Canada, which, if you are American, is similar to a Chapter 11. It's a court-driven process to restructure your affairs. And in this particular situation, which we're seeing a lot in real estate deals right now, and other type of private lending deals, you're able to go to court and you're able to say to the court, to the judge, we just need to stop, calm everything down, issue a stay against past creditors so they can't come after us. And it makes sense for the business, for the stakeholders, for the community at large, for this business to continue and get back on its feet. And that's exactly what Sirona Pharma was doing. Let's just calm things down, stop the creditors from moving in. Let's get our act together with respect to the regulatory side and, see if we can get the cannabis license reinstated. But to do all that, we need some money. It takes money to pay the professionals to go through this very, very expensive process, all things considered, a CCAA. In comes the debtor in possession loan, which is a loan where the court says, okay, well, you, lender, can have a priority position, secured position over all of the assets of the business ahead of everybody, ahead of the bank, if there is one, ahead of the first mortgage, second mortgage, third mortgage, ahead of CRA in many cases, ahead of the property taxes on this big piece of real estate. And so that's what a debtor in possession loan is. And the idea there is that it entices a high yield secured lender, of which, if you listen to this show, Sinclair Range has a few, including recently announced Interim Credit, which is doing these types of high yield asset base, including debtor in possession loans in Canada. And so we needed a debtor in possession loan. And so we introduced the company to Sapphire Global, which you've heard me talk about on this show before. And we also took the position of Sinclair Range, not me personally, but somebody else, as a chief restructuring officer of Sirona. What is chief restructuring officer? This is somebody who either in a court process like a CCAA gets approved by the court as a court officer. And we often do these same mandates, CRO mandates outside of court. But the general idea in both cases is that you could be the best CEO on the face of the earth. You could be a high growth CEO. You could be an administrative, culture building CEO. You could be fantastic at what you do, which is growing your business and making money. But that does not necessarily make you fantastic of leading through a crisis, of transition management, of turnarounds, or getting through high growth. And that's what a turnaround leader does. And another name for a turnaround leader is a chief restructuring officer. There's other parts of that gig, of course, including negotiating the restructurings to the extent that you're doing a restructuring and not just a sale process. So that's what a CRO is. And of course, you need a debtor in possession funding to do a CCAA to pay the lawyers, the monitor, everybody associated with the file. So Sinclair Range was CRO, Sinclair Range through Sapphire Global organized the debtor in possession loan. And here's the key point about this DIP loan from Sapphire is no one at Sapphire, apart from Sinclair Range, had anything to do with Sirona Pharma. It's completely outside money. And the team at Sinclair Range tried to source, and the company itself tried to source this debtor in possession loan from anybody else on the face of the earth. They were getting no traction. So they called me at the last minute. I brought in Sapphire Global. And like I said, the important piece of information is that they have no prior connection to this file. Very often debtor in possession loans are provided by people already involved, already lenders or shareholders or key customers or whatever. They're provided by somebody who's a stake, like an organization that is a stakeholder already of that file, but not in this case. In Sapphire Global and now Interim Credit on larger deals will be providing DIP financing. So if you have a need for this, reach out and let us know. Well, that was last October, November, somewhere in that range. And the end of July this year, we're done. We're done. The company got its Health Canada license back. It's a good to operate cannabis facility. Again, it went through a sales process. There was a buyer. The key employees still work there. And Sapphire got all of its money back, plus its interest and fees and all that sort of stuff. So if you follow the Sinclair Range story, particularly on this show for the last year or so, hi, JR Rataj on Instagram. Thank you for joining us. If you've been following our story, you know that we've been working very, very hard to implement a strategy of merging services and capital. And so that helps a business that's going through a transition. It could be a business that's going through a period of high growth and it needs to get from here to there. It could be a business that is experiencing distress, right? And so it needs to go through that period. But you're going through a transition in your business and you need both advice, that turnaround leader, someone to help you negotiate and get from here to there. But you also need capital to do that. And now Sinclair Range is able to provide both to its clients or one. If you just want the advice and no money, that's fine. If you just want the capital and no advice, that's fine too. And so, along those lines, often it's appropriate for us to providing a client capital solutions from the market as a whole, as opposed to Sapphire Global or interim credit. And sometimes we need to do both, and we rely on the knowledge that we have, the comfort that we take from the services side, to often do deals that nobody else is willing to do from the outside, if that makes sense to you. So bottom line is we can do both. There is a merging of services and capital, and we're starting to meet that need, and it's getting real traction, and I'm excited about that. And so the question becomes from other intermediaries, right? Because on the lending side, we do deals, we lend money on other people's deals as well, all the time. It doesn't have to be our client. And the other intermediaries, accounting firms, law firms, may say, hey, you have a conflict. You have a conflict. Your client is the borrower and your client is the lender. How do you manage this conflict? Well, good question. Let me tell you, as a premise, my thinking about that. This is the way the investment banking world works in larger investment banks, investment dealers. They have a client by engagement letter that is an issuer of a security if they're going public, for example, or doing a secondary securities issue. So they have a client, and then they have other clients, directly or indirectly, that are purchasers of such securities. And frankly, their loyalty is to the source of capital. The issuer of the capital very often is one time or 2 or 3 deals over the life of that client. But the source of capital, they put them into every deal they possibly can. And so where do you think the loyalty rises? Either way, they're making money on that trade. And so they have that built-in conflict. But also in these larger deals, investment banks, they do the due diligence work. And everybody is relying on their data room, on their due diligence. Often, certainly back when I was paying more attention than I do these days, so I don't want to say it still continues, but they do the valuation reports, the fairness opinions. So they say, okay, well, my client is going to do a deal with my client, and here's my report that says the deal between my clients is a fair deal, and the regulators and the market at large should accept that deal. They trade the stock before, during, after. They have to create a market to get the deal done. So often that becomes part of it. Sometimes they commit to do analyst research from the bank post-transaction. That's part of getting the deal done, whether it's explicitly said or not. So there's all sorts of conflicts in this business at the larger level. And why do I tell you all that? Well, it's structured that way. I mean, it sounds horrible when you think about it, but it's structured that way on purpose because it's effective. That's how, incredibly effective. That's how deals get done. And we're not going anywhere near that level of conflict in the private stuff or junior public stuff that we work with. But the concept is the same. If we can get money to a client that otherwise can't get money because we're working with that client, the lender has trust in us, is willing to rely on our information and disclosures, well, that's good, isn't it? Isn't that good for the market as a whole? So that's what we'll be doing. Hey, Tix Systems joined on Instagram. Great to have you here. Thank you for joining us. Services and capital are merging. That's a fact. And I think that Sinclair Range is perhaps a little bit ahead of its time, certainly in our corporate finance space. We have another client in the automotive sector and aerospace. I've told you about these guys a million times. Good little manufacturing company. The tariffs hit. They're doing a ton of cross-border work, Canada, US, in the automotive sector. Revenue drops 80%. We've been working with them close to a year. I've got them stable. They're not burning cash. Things are looking pretty good. But the bank called their loan. And so we had to enter in a forbearance agreement. To remind you what a forbearance agreement is, this is a private contract between a borrower and a lender. And that from the borrower's perspective says, hey, I admit that I owe you all this money and your security is valid. I'm not challenging any of that. But you agree, Mr. Lender, banker, Ms. Banker, to give us more time to do what we need to do. And in this case, what they needed to do was get some investment or sell the company. And ultimately, long story short, Sapphire Global purchased the debt. This is one of Sinclair Range's funds, purchased the debt from their lender, and it bought that debt at a discount. In other words, the bank was owed 100, so the company owes 100, but Sapphire was able to buy that 100 from the bank for $50. And so now the company owes Sapphire 100, but Sapphire's cost base is 50. Makes some sense. So the bank effectively took a pretty big haircut. And many companies come to us at Sinclair Range and say, hey, man, we need your help to negotiate with our lender because there's no way in hell that we can pay them $1 million or $100 million, whatever the number is. And so they should take a haircut. And we should pay them 50 cents on the dollar or 75 cents on the dollar. And they never ask themselves why. Why would a lender ever agree to do that? Is it because you asked them? No, that's not how this works. So the trick to this type of negotiation is, first of all, it shouldn't be you. Lenders don't like to give haircuts to the principals, particularly in medium and small businesses. Maybe in larger public company type files, they would do that. But in a private company, owner-manager business, they'll do a deal with somebody else, but it's way more difficult to do a deal with you if you're the one that borrowed the money and put them in this situation. But regardless, you can't just go ask your bank to take a haircut. They have to go through a process. They have to go through a journey of discovery to find out what the market thinks their debt is worth. And that's what a SISP is, a sales investment solicitation process. You go out to the market with a credible third party, you market this business, and the market and the outside world at large says, hey, bank, your $100 receivable is not worth $100. It's worth $50. That's what a sales investment solicitation process does. And if you're a banker and the company goes through that process, it gives you the ammunition to have internally, to have a real chat with your credit committee and say, hey, I know we all want to get 100, but if we put a receiver in, we might get 40, and the market's telling us we get a 50 right now. So that's what we ought to be doing. Don't forget the journey. The journey is very important for your bankers. Speaking of this whole private credit world and problems that borrowers have with their lenders, over the past maybe 2 years, we have had many small businesses, not even really medium business size businesses, but mostly at the small end, that have come to us and they have been sucked into the merchant cash advance world. Are you familiar with this product? We've talked about it before. Imagine yourself running a small business and Wednesday is payroll and you need $25,000 and you're short. It's Monday today. You have no idea how you're going to get this money to meet payroll. And that's kind of the end of it. So you're sitting around at night and you jump on the computer and you go onto these online platforms, the portals, for funding. They say they can advance money right away, and you apply for a loan and you send them 6 months of your actual bank statements. That's the due diligence through the portal, and bang, you're approved. This is awesome. You sign a bunch of forms through the portal and your money shows up on time for payroll. Maybe even you got a little bit extra to do a quick trip to Vegas, because you're sure as hell not going to spend that money on fixing your business. You're just going to cover your immediate trouble. Let me give you a real example from a client of ours. They took $15,000, and it's not just, I'm telling you, you don't know who the client is. We've had many of these. over the past couple of years. They took a $15,000 advance and contracted to pay back $20,850 over 90 business days. And the way that is done is the merchant advance company goes directly into the bank account and debits every single day an amount that adds up to $20,850 over 90 business days, which is $5,850 profit, which is a 100% plus annualized on a simple basis, but on a compounded basis, which is the appropriate calculation. It's several 100% return to the merchant advance company and a several 100% cost of capital for that $15,000 to that small business. Now, you get the money, you meet your payroll, you're paying several 100% for this capital. Do you fix the business and the underlying problem? No, because the underlying problem is way more difficult than just meeting payroll today. You've got fundamental issues with your business. That's why you're in this situation. So what do? 2 months from now, the same situation arises. You think to yourself, maybe I can do this again. And you go back to the portals, a different company, because there's hundreds of these, and you, in North America, and you take another one. And the same situation, you solve your problem, and now maybe you got 25,000 or 30,000. And what happens is, what we see in these small businesses is they've layered 5, 6 or more of these loans on top of each other, all of them coming out to several 100%. And effectively what you've done is your entire capital stack, the right-hand side of your balance sheet, your cost of capital is now well over 100% weighted average, several 100% weighted average. And obviously no business can afford that. In Canada, the criminal rate of interest for a loan between $10,000 and $500,000 is 48%. I think that's the right number right now. But there is a cap on this. There's a cap in almost every jurisdiction that we operate in. The rates differ, the rules differ, the calculations differ, but there's a cap. And what these merchant advance loans do is they operate at multiples, multiples of that cap. So how do they do that? Well, what they do, you might ask yourself, what they do is Manu on Instagram, thank you for joining us. What they do in their paperwork is they write it up as a purchase of receivables, but not existing receivables, of future receivables. So they say, well, we're not loaning it. This is not a loan. That would be illegal. We're buying from you future receivables. There's no schedule. They never refer to what receivables exactly. There's no schedule of receivables purchased. There's no due diligence on receivables. They don't ask you what your receivables might be in your future or who your customers are. There's no reconciliation when a future receivable, something you invoice next week, when that's collected, there's no reconciliation of all that. They don't care less. They could care less about your receivables. Instead, there's a fixed daily withdrawal or weekly withdrawal with some of them out of your bank account. That's it. And then they have a personal guarantee behind it for this loan that is not a loan, that it's a purchase of future receivables. They say that with a straight face. That's what their paperwork says. They take a security registration, many of them, against the assets of the company for this loan that is not a loan. Obviously, it's a loan, and we are in litigation now with a couple of these for our clients. We're not lawyers, but we help out where we can. We're suing, I think, 2 of them. We're suing, one of them's a shady legal counsel. We'll see how all of that works out. But here's, I think, the takeaway for owners right now. If you need $15,000 for payroll on Thursday, you need $15,000 for payroll on Thursday. But know what you're getting into. And if you start layering these things, and if you don't fix your underlying business, this is the new version. This is the 2020s version of a death spiral. You layer these things up, you're in a death spiral. There is no way to get out of this at that cost of capital. The personal guarantee is going to follow. It's going to make this follow you home. And at some point, what do you do? What do you do if you made these mistakes and you're in this position? There's only one thing to do. You have to put a stop payment on those pads, on the pre-authorized debits, because you're dead if you don't. You're in this death spiral. That's the only way to break the spiral. And you need to understand that if you put a stop payment on those pads, that you've broken the contract and you're going to have to take the fight. But it's the only thing you can do, because they just suck the money out until it's gone. You know, they're prioritizing themselves, in effect, over the more senior lien creditors like the bank, because the bank just gets reporting and whatever the style of reporting is for their loan, a commercial loan or an ABL loan or whatever it is. But they have to go through notice periods and act on their security and this and that. Whereas these merchant advance lenders are just sucking the cash out of the account every single day, which in effect puts them above of the senior lenders. Beware of those things. It occurred to me, I think I put it in the newsletter last week, that if you are a company and you're looking to raise money, I've talked to a bunch of them over the last year as we've been out raising private capital for our lending funds, for example, at Interim Credit. Give us a call if you're looking for high yield secured debt, not anywhere close to those merchant advance companies, a reasonable number. But if you're out raising money in your business, trying to go to angel investors, family offices, high net worth individuals, right, which is a strong market often for businesses, high growth businesses in particular, and you're hearing no a lot, and you wonder yourself why. Like, I got this great deal, I could generate a great return, maybe in the 20s. Why am I not getting any traction on this? Do I suck? Does my deal suck? Are there other deals you think, well, maybe I'm underpriced, or these other deals, like everybody's in the market trying to raise capital, maybe there's too much competition? Well, there is too much competition, but it's not the competition you think. You're dealing with high net worth individuals, you're dealing with family offices, and the competition is their brokerage account. What does that mean? Their brokerage account. Well, the S&P 500, in case you've missed it, was 26% gain in 2023, 25% gain in 24, 18% gain in 25, a 23% a year compounded over the last several years. It's up double digits again this year in 2026. What are you offering? If you're offering 20% and they're doing 23% already in their brokerage account, that brokerage account is liquid. They can sell and get cash out on 3-day settlement. It's diversified across a basket of stocks, not just your one deal. And never once has that brokerage account called them with a problem about payroll or needing an over advance. That has never happened. So the question becomes, why? Why would a high net worth individual do your deal, withdraw money from their brokerage account, pay the tax on it, right? Because you sell the security, there's tax on those gains, put it into your deal, which after legal fees, costs, a different set of risks, may in fact return less than the brokerage is already doing. And, they put it into your deal and now they're illiquid, right? If it's a private debt deal or bridge loan, you're probably going to be at a minimum 3 to 6 months, probably a year to 18 months. If it's an equity deal, you might be there for 5-7 years. There's no liquidity at all. So why would they do that? You can't beat the S&P 500 with your deal on returns. We all know the bubble is going to crash, and someday you will, but you can't beat it on returns, and that's why you're struggling. So what do? Instead of that, you're pitching a healthy return over, in comparison to the benchmark, but also real security over real assets. That's your pitch. We know the bubble's going to burst in the S&P 500 in equities. We know that's going to burst. That's why we believe in private credit. You want to talk about that more? Give us a call. All right, we're half an hour into this. Do we have any comments I need to respond to? Hey, Catherine, thank you for joining us on Instagram. Where are we? I think that's the end of it. Thanks for listening. We'll see you maybe next week. I think I'm traveling, but we'll see what we can do. Don't forget, there's a newsletter out. You can look at sinclairrange.com and check that out. If you're listening to this on Facebook, LinkedIn, YouTube, X, Instagram, wherever you are, give us a thumbs up, please. Hit subscribe or follow or whatever it is on that platform. That's always helpful to us. And reach out in the notes or reach out at the sinclairrange.com site if you're a business that needs some help navigating high growth, needs some help navigating financial distress, needs help doing deals. That's what we are here for. And we have access. In fact, we have the capital to potentially help you out. Thanks for listening. I will sign off now. We'll talk to you next week.